All right, so the 1980s, the economy was recovering from the 1970s and growing, and unemployment was falling again. There was that recession in 1981 due to the savings and loan crisis, but once again, it had a very quick turnaround, and recovery happened almost immediately. What Team Keynes people, there's a lot more here, but it gets off into too many tangents and weeds that I'm kind of covering some of the highlights that are a little more related to our class. There's something called the Laffer curve. It's a curve that shows that if tax rates are at 0%, you're not going to raise any revenue. If tax rates are at 100%, you're not going to raise any revenue. Raising taxes can mean less revenue, and cutting taxes can mean more revenue. The Laffer curve kind of charts the degree of increase or decrease in revenue with an increase or decrease in taxes. You reach a point as you raise taxes to where you're now going to start losing revenue. And when you start cutting taxes, you can start gaining revenue until you get to a point where you're going to start losing it. Economists don't really debate the logic so much as where that peak is. Some economists will say it's as low as 40%. For the top tax rate anyway. Taxes above that level, you start losing revenue. Other economists will say it's as high as 90. There's no consensus agreement there. It's very difficult to really answer the question. But Reagan he really became prominent during the Reagan administration because he proposed cutting taxes and said we're also going to reduce the deficit without reducing spending. In a debate where he proposed this ahead of the 1980 election where he was running for the nomination against George H.W. Bush, George H.W. Bush coined the term voodoo economics to describe that sort of thing. Reagan won the presidency, he cut taxes, and deficits rose. And Team Keynes says, well, there you go. It doesn't work the way he thought it would. They also pointed out that the economic growth of the 80s was inevitable and would have happened if Carter had served another 4 years and then Mondale had taken over for another 8. We would have seen the same growth. It was to be expected and not something you could attribute to any supply-side policies like tax cuts or deregulation. They also point out that the inequality we've been seeing over the last decade or so that started during this period, before then we talked about how in the 50s, incomes grew across the board at roughly the same rate. There was some contracting, some dropping of inequality, as usually happens during recessions, and it started growing again right at the beginning of the Reagan presidency. Reagan also was a financial deregulator, and it's one of the things when we talk about the 2008 financial crisis, he kind of kicked off the deregulation that led to it, according to Team Keynes. Team Hayek says that the deficits were due to defense spending. Reagan saw that the Soviets were on their heels, and he really ramped up Cold War spending to try and, Team Hayek would be among those people who credit Reagan for ending the Cold War in the Soviet Union through massive amounts of defense spending. But revenues did actually rise, even as taxes were cut, which is attributable to economic growth. So again, there's a question as to whether the growth would have happened anyway and revenues would have been higher. But because revenues rose and defense spending was kind of unprecedented, you can't say right away that Reagan got the Laffer curve peak wrong. You can't necessarily say he got it right, but you can't necessarily say he got it wrong. We brought up inequality a couple of times. We didn't really mention the Team Hayek view on it, which is that it really doesn't matter. As long as all ships are rising, if some people should be getting paid more than others. The question is, are the poor doing okay? Are the middle class doing okay? That's all that matters. We will revisit this at the very end. Again, we're not going to give it nearly as much treatment as it's a very deep and multifaceted and more complex issue than a lot of people want to make it into. But we will bring up a couple of things that maybe aren't brought up very prominently. As far as the culture of deregulation thing, Team Hayek will point out that people just call Reagan a deregulator, but nobody's willing to point out any specific details there where if Carter and Mondale had been presidents throughout the 80s and then Clinton took over and did the things that he did, would the financial crisis have been any different? No one's willing to say it would. So the Reagan having a role in the 2008 crisis is dismissed by Hayek types until someone can be a little more specific. Then come the 1990s. We've talked about the 90s as a massive economic boom, in many respects the biggest ever. And a Democrat was president, according to Team Keynes. Clinton also cut taxes right after taking office in 1993, I believe was the year of his, he raised taxes on the top 1%, and it was followed by a massive boom, which further undermines the more Hayek-like argument that says you want economic growth, cutting taxes is a great way to do it. Team Keynes also points out some problems from the 90s, though. The market economy is doing great, but a feature of capitalism is inequality, and it grew even more during the 90s. And then Glass-Steagall was, there were a lot of regulations that were enacted right after the Great Depression that put a few more controls on in the financial sector, so to speak. And Glass-Steagall basically said that investment banks and commercial banks, they can't be the same thing. Citigroup was formed during the 90s and was a large donor to the Clinton campaign, but their merger that created Citigroup required that at least part of Glass-Steagall be taken away. And that partial repeal by the Clinton administration enabled Citigroup to form. And it also got rid of a Depression-era regulation. Team Keynes will point to that as more of the deregulating that eventually led to 2008. Team Hayek says that the economic growth happened to the Clinton presidency. Again, if Bush had been president until 96 and then Bob Dole until 2000, the economy would have grown just the same. It was the tech boom. It had nothing to do with anything that anyone in government was doing. But Clinton did cut the capital gains taxes, which increased investment and made the boom bigger, according to Team Hayek. The balanced budget, extolled by Team Keynes, is another thing that happened to Clinton, according to Team Hayek. There were a lot of harsh negotiations between the Republican-run Congress and the House of Representatives in particular, and the White House, where Congress wanted bigger cuts. The White House didn't want cuts, at least in the areas that were being cut. Government was shut down. There were a lot of messy standoffs. So Team Hayek says it was really the Republican Congress, not the president. And they also point to the fact that once the budgets were laid out, both the Republicans in Congress and the president were expecting the budget to be balanced in the early 2000s, that they had laid the groundwork for it. Then the budget gets balanced towards the end of the Clinton administration, and because of the massive economic growth. And we talked about how automatic stabilizers work and how that sort of thing happened. As far as Glass-Steagall, no one has come out and described how the 2008 crisis would have been any different or any worse had Glass-Steagall not been touched. So the partial repeal, again, didn't seem to have anything to do with anything. The Community Reinvestment Act was signed into law by Jimmy Carter, and the Clinton administration started using it to force banks to maintain quotas of loans given to lower-income borrowers who might be higher risk as a way of trying to expand home ownership and pull people out of poverty. And that is something that Team Hayek says is the entire reason for the financial crisis. We kind of gloss over the 2000s because a lot of the arguments are the same as during the 80s. The dot-com bubble burst right after Bush took office, and then 9/11 happened, so there was a lot of economic tumult. And then between 2002 and 2007-ish, the economy actually grew quite well. And some of the same arguments we've already covered come up there. But the big thing, of course, that really kind of defines the Bush presidency, right or wrong, is the 2008. I always refer to it, you might have noticed, as a financial crisis. I don't like saying the Great Recession. I think that's kind of a misnomer in a lot of ways. There were a lot of recessions that were a lot bigger. I understand trying to liken it to the Great Depression because for a lot of reasons it should be. But it was a financial crisis, and that kind of focuses on what needs to be focused on. So we've already talked about the culture of deregulation that Team Keynes says existed throughout the 80s and on through the 2000s, where people could just, on Wall Street, whatever they did, the attitudes amongst government officials was, let them do it. If it's bad, then the market will fix it or something like that. MBS stands for mortgage-backed security. We talked about those with the bank balance sheet. You can sell your loans, or at least part of the right to receive repayment on the loans. That money goes to whoever bought the right to receive those payments. And it's basically a derivative. You hear about derivatives, weapons of financial mass destruction, according to Warren Buffett. These have actually been stabilizers for the banking system for generations. They weren't new. What was new is that a lot of the loans in these securities that were being traded, people were buying access to these streams of payment, were subprime loans as well as prime loans. Subprime loans, again, are given to people who are higher risks for not paying it back. And a lot of investors who would create these loans and then sell them off to other people weren't as forthcoming as they should have been, that they were laced with subprime loans. Team Keynes people say that that's entirely because of the regulatory environment. They thought they could get away with it. And so consequence-free yield seeking just led to more creative ways of essentially defrauding people for higher interest rates. And when Team Hayek comes out and talks about the Community Reinvestment Act, it is a fact that only 10% of subprime loans in the system as of 2008 originated from institutions who were regulated by the Community Reinvestment Act and were required to keep those quotas. Team Hayek types will point out that, again, nobody can really point to any regulations that had anything to do with anything. And we'll talk about that 10% rebuttal about the CRA because what they'll point out there is that it misses the point. If you push the snowball down the hill, the snowball gets really big as it rolls down the hill. If you blame the person at the top, defending them by saying that that snowball was only 10% of the snow was in there when the person packed it and pushed it down, is missing the point about what happened as it went down the hill. CRA regulated institutions, bigger banks basically, didn't want to originate subprime loans. So they would essentially buy loans from some of those strip mall-based predatory lenders who would really try to pressure people into buying them, which they wouldn't have done, according to Team Hayek, if the big banks weren't looking to maintain those quotas in the first place. There were virtually no subprime loans in the system before Clinton took office, and they were all over the place once he left. Also, Glass-Steagall, it affected a CRA-regulated institution. So less than 10% of loans came from Glass-Steagall. That's another rebuttal that's brought up. Basically, if two buildings burn down, and Team Hayek makes this analogy where we have a guy on video with a flamethrower torching part of the building, and Team Keynes people say, but only 10% of the building made contact with the flamethrower fire. How did the rest of the building catch fire? That's kind of what the Team Hayek people say. Cultures of deregulation don't have specificity, and we have to take a leap of faith to say that the whole thing would have happened on its own. We just needed deregulation to happen, according to Team Hayek people, while the CRA thing basically explains every single part of it. There's a lot of coordination that would have to happen throughout the financial system for the whole thing to be possible. You have people who originate the loans, you have people who write the loans, you have people who buy the loans and turn them into securities, people who buy those securities, and then other people. There are a lot of different components of the financial sector that don't work very closely together, that really have to be coordinated, and we know that the government did some coordinating of it in order to keep the whole thing from blowing up while Clinton was in office. So that the Hayek team also points out, Hayek was dead by the time all this happened. He died in, I believe, 93. They point out that the Fed also maintained low interest rates. As we saw with monetary policy, low interest rates are for struggling economies. Economic boom periods should not have low interest rates. That helped with a lot more yield seeking and some of this bubble-like behavior. So Hayek types will also point out Fed policy. And we'll talk about post-crisis and how everything was handled in the next video.